Hi everyone, thanks for dropping by my channel again. What a week has it been? And in this episode, we're just going to quickly recap a little bit what has happened, what I think will happen moving on, and what are some of the stock picks or some of the stocks that I have on my watch list moving onwards. Now, let's talk about the turbulence. And oh my God, what a Easter weekend have we had? In my previous videos, I have mentioned this before that during this Trump presidency, I think one thing that is going to be consistent is that the inconsistencies that Trump brings in his words and in his actions. And unfortunately, this will continue to affect the market in a very negative way. As an example, over the Easter holidays, Trump has called Jerome Powell, the Fed chair, a loser, slow to act reducing the interest rate. And of course, the market reacted quite badly towards that piece of news, and it dropped 3%, I think, uh, just before Friday on the S&P 500. That the market doesn't like when the Fed chair and the government is not acting in unison in terms of the entire economy. 2 days later, we saw Trump backtracking, retreating, and saying things like he never intended to fire Jerome Powell. He was just acting out of frustration. And of course, on that news, the market recovered a little bit, 2%. I'll have to say that the caption here isn't about all the news, but the unstoppable market force that Trump wields is immense. And not only that, it's not just the US stock, it's potentially other stock markets as well across the globe. We used to, of course, look at, as you know, the candlesticks, the peaks and the troughs when it comes to market investments. But now, all we need to do is just watch Trump news. Um, and I think that is going to be some reality moving onwards that we need to sort of factor in and just keep, I guess, at the top of our mind instead of at the back of our mind. Now, equally important, another piece of news that I think maybe outweighs just a little bit is, of course, this continuing Trump um, and tariff and the relationship with China. So you can see the headlines at the moment. Everyone is probably gasping for air in terms of an end to the trade war. But I actually think that there's probably just going to be a little bit more of this spectacle moving onwards for probably another couple of months, similar to the Trump retreat of his position of Jerome Powell. We have now seen a retreat on the tough trade policies against China. We have seen it over the weekend of the Easter weekend, not this weekend, the softening of the tone. We heard Caroline Levitt speak to the public, and she carefully chosen her words. Negotiation is heading in the right direction. And of course, we have seen China come out flatly refusing and calling it fake news that the Chinese are not in talks with the US of any trade negotiations. So I think this is a space to continue to watch. Um, and I think the seesaw will continue to play on the market, and therefore that's the takeaway for the moment. What we can expect is further turbulence, volatility, and instability on the US stock market. Now, the next topic I want to quickly chat to you guys about today is the theme that I've been seeing on a lot of YouTubes, by the dip, millionaire made tomorrow or millionaire made in 2025, 1,700% increase, uh, prime opportunity, etc. Now, I agree with all that. I agree with buying the dip. But as retail investors, we just need to bear in mind what that actually looks like in reality for ourselves and what do we need to prepare. And there's two things I think we need to prepare ourselves for. To illustrate that, I'll quickly show you the S&P 500 chart that I was drawing some lines on yesterday. And this is obviously recent times. Buying the dip means you buy precisely at this point, this point, this point, this point. And of course, at this point, you know, it goes all the way up. But the truth of the matter is, we probably would be buying the downward trend. And there's two things that we need: money and mental strength. What does that mean? Well, I'm just going to quickly go into one of the stocks that I have, and I still very much believe in, and that is Uber. Um, so you can see here, in my mind, anything below $70, uh, 60 even better, is a buy for Uber because I think there's real value, and I will talk about this stock a little bit later in this video. And I think it's a stock that has shown great resilience during this Trump tariff period. But to illustrate my point, if this stock goes continuous downwards, um, you know, you need to have the money there available in your cash account to buy the dip or buy the downward trend. And of course, it will rebound. And history has shown that this, companies or their SPING 500, it always goes back up. And I think as long as you're investing in value companies such as Uber, Microsoft, the Magnificent Seven, they won't go away. But the share price may fluctuate from time to time. The mental strength is again sort of a little bit coupled within, which is knowing that you're investing in a value company, and not let the voting of the fluctuation of price get to you before, and you sell too early. So that's probably something that we need to keep in mind of. But before I go and talk about my stock for today, maybe I'll show some more gloomy news of this next clip. It is an interview between Bloomberg and Peter Berezin, which I thought was very interesting. So let me just play the clip.
Forecast was for the S&P 500 to fall to 4450 by year end. Is that your base case scenario? Is that your worst case scenario? Are you changing that up in any way?
It's my base case scenario, and I'm not changing that target because much of what's transpired over the last few months was very much in line with my expectations. 4450 is actually not that dire. To get to 4450, all the S&P 500 needs to do is trade down to a forward P multiple of 18, and for earnings estimates to decline by around 10 percentage points. 18 PE is not that low. The average P ratio between 2015 and 2019, a period which didn't include a recession, a period which encompassed most of Trump's first term, the average P ratio back then was 16.8. I'm talking about 18. Likewise, a 10% drop in earnings estimates, a typical recession is closer to 20%. So if anything, it might be too bullish.
So, some very key information there. So, in short, I think what Peter is saying is that the market currently is overpriced. Now, we knew that already because the market has already corrected, and I think the correction is somewhere between here and here. That's a 20% range that I'm sort of wavering at the moment. The next thing, of course, I think is the Trump tariff has expedited that particular correction. I was actually, if Trump didn't bring in any of these tariffs, I think the correction would actually happen maybe in the first quarter of 2026, January 2026. Thereafter, of course, then the correction will be much larger in volume. But I think Trump tariff have simply expedited that particular price correction. The next thing that he talked about, I think, is equally true, is that the forward P ratio in 2019, when there was actually no recession, we were all coming out of, or actually going into the COVID, but then with such a massive amount of stimulus injections, there was no recession. The forward P was on average 16.8. Trying to find a 16.8 P ratio in the S&P 500, very few companies actually have that, and that's why if you look at my particular sort of account holding of the companies, I think Uber is one of the ones that I like to hold, 17. Um, he's probably considered that as expensive. If you look again, um, I think Dell is another one that I bought. Um, that is at a P ratio of 14. Google is looking very attractive at the moment, with earnings just come out. obviously went up quite significantly. But when I bought it, I think it was trading at about 16 trailing PE. Forward PE is still 18. So all of these companies at the moment is the companies I've been buying. I'm not touching anything that's higher. I think Amazon actually is at about 30. Yeah, and Nvidia's and AMD is just off the chart. So that's what Peter is trying to say. It's overpriced. The market is still very much overpriced, still with such a big correction, and that's why he thinks. I guess his warning is that guys, 4,400 is just another 10% away, and we saw the market drop 3% on one day. Just take 3 days of continuous sell-off to get to 4,400, and not far away from 4,000. So that is the 40% range correction. So if you invested at this height and you lose 40% of your value, that is something quite dire. Again, going back to the mental capacity and I think that capacity depends on how much cash you still have to buy the dip. That's why I still have some cash left over. Um, uh, uh, Timing that particular buy when I need to. All right, so that's in terms of the news trend and sharing. Now, before my last topic for this video, if you're still here enjoying the content, please consider liking the video and smashing that subscription button. I do upload new videos every week. All right, let's get on to stock recommends. And my stock recommend for you today is Uber. Now, Uber has been moving sideways for some time, but if you look at the Trump tariff period, it's obviously dropped just like the rest of the stock market shares, but it has rebounded to nearly the same level in February, which a lot of the other stock have not. And I think that's obviously my definition of a resilient stock. But of course, there's some logical reasoning. Uber doesn't operate in China. Uber is not a import-export business. It does operate in a lot of countries across the globe. And I think that's because of its business model and because of the nature of the business, it's been shielded away from a lot of this turbulence. And of course, this is reflected in the stock market. But the reason for recommending this stock is not just because of resilience, obviously, for the next couple of months, whilst the trade war continues, but it's because of other pieces of news that's coming through. So you can see here that Tesla stocks soaring for 10%, and robotaxi has been in the domain for some time now. We all know that if robotaxi takes off, becomes safe, widely adopted, it's a huge piece of income generation, and that's why Tesla is chasing that piece of pie. But right now, I can tell you Tesla doesn't have a robotaxi. We know it has self-driving cars, but it doesn't have a robotaxi. Who's delivering those services at the moment? It is Uber and Waymo. So you can see in this article that it's already in Austin and Atlanta, and I know that it has plans to expand to many other different US cities such as Washington, D.C., Seattle, Silicon Valley is on its target, and Tokyo. And I'm just thinking Tokyo is a very complicated city with very small roads and a lot of roads. So it's already operating and it has confidence to operate in those markets or in those places. So I do think that our future revenue, that is a huge piece of revenue coming into Uber. Talking about management, I mean, if you listen to Warren Buffett investing management, have a look at this particular company's obviously track record. A very consistent, I want to say exponential, like Nvidia, but very consistent revenue growth, very consistent net income projection and growth here. And I think to turn this, I guess, tech company from such a challenging loss period into a positive growth period. It requires, I guess, strategic focus and execution of those strategic focuses. There's obviously some other news as well in terms of Uber and beyond the robo taxi, and that is it's AI and data. Now we know that Uber has a lot of data over the years collected by operating its um, business. And now we get this piece of news that it's also chasing a piece of pie in the AI game. They do have a AI model that they're training called Michelangelo. Now, I have to say, not quite sure where this is going, but because it's Uber and its management and they're investing in this money, I do think that they are also in the business of commercializing something. Um, we know that these AI models require a huge amount of data in order to train itself. And I do think that's where the Uber advantage is. It doesn't need to go out there and acquire data. It has already a lot of data. And by training its AI model, hopefully they can also monetize this, just like Google as well. That's monetizing their AI model, Gemini, in their most recent report. So I do think that Uber has more things going on for it. I don't think the market is seeing it for the moment. And when it does, that price will obviously increase dramatically. So definitely put that one on your watch list as well. Now, that comes to the conclusion of my episode today. If you liked the video and the content that I provided and wanted to see more, please do hit that like and subscribe button and smash that bell icon as I do update every week with the latest news and trends and stock recommends. Thank you all very much for sticking around. Enjoy the rest of the weekend, and I'll see you all next week. Bye.